Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to latest session update for Tuesday, April 1st, 2025. It is 1:34 p.m. as I'm starting the video, so we've got another couple, 2.5 hours left in the trading day. Just figured I'd get one out to you with my thoughts on the market. I'll keep that relatively brief. I've been covering the market ad nauseum lately in detail. So you have the levels, you have my thoughts. Nothing's changed, obviously, since last night. I did a post-market wrap-up. But let me just kind of do this. I told you when the markets move, you get the volatility picks up. The charts are dynamic, I always say, and that means they're constantly changing, and they change more rapidly in a fast-moving, volatile environment. Hence, you're going to get more updates. That's also when traders make their money. That's what this site is about: active trading, swing trading. But there also, I speak to the long-term trader, investor. I am both. I told you I wear both hats. I have long-term accounts, retirement accounts, IRAs, kids' college, educational accounts, Coverdales, where you can, invest money into whatever you want, unlike 529s that are limited to fund selection. So that kind of stuff is when I say long term, and I wear those hats, and I don't actively trade there. And then the short term stuff. So, yeah, not trying to be, one size fits all for everybody, but just trying to let you know I will always speak to, when I'm doing these videos and cover an analysis, what is relevant and significant for an active trader, or what is relevant and significant to a long-term trader. In other words, long-term traders shouldn't be overly concerned or concerned at all with when I start getting down to 5-minute charts and 15-minute charts and looking for 1, 2, 3% counter trend bounces within a trend. Long-term trend traders and swing traders targeting, double-digit moves and trying to capture a bulk of a larger trend might just opt to sit tight and maybe use that short-term analysis, if anything, to add or subtract to positions. What did that mean? Let's say you got out at a point, you wanted to book some profits, and then you're looking to re-enter, or you took a trade, you didn't, weren't sure of it early on, so you took a starter position, and as the trend starts to develop, and that's what a lot of pros do, you want to add to that position. I've always said this: retail traders, aka they call it dumb money, they tend to average down on a stock. If they buy XYZ at 100, it drops to 95, then 90. They keep buying, figuring they're lowering, quote unquote, lowering their average cost, which technically they are. However, pros do the opposite. They tend to, again, they will buy a stock at 100 and only add if it goes up. And they're adding at higher prices, but what that does, it tells them they were right on their call, not wrong. And so the retail trader can be buying down to 67, 70, 60. At some point, they realize they were dead wrong on the analysis, but now they've been throwing good money at bad. So I just want to kind of throw that out there and also let you know, if I have a predetermined trading plan to scale into a position, that's what I often do, even if that includes, long trades buying. I call these the Mag 8, and because of their extreme, tremendous weighting on the indexes, and that's it. That you can look down below, the vast majority are red, and you can do it another way, as I've showed you my real-time indicator. Just click this way, sort by gainers. There's 101 in the NASDAQ 100, so I click on the last one, positive. You got a plus 0.01, 0.01. So I'm going to go right here. That just equals the two that are flat. And it tells me right here 46 of the 101 stocks. So less than half of the stocks in the NASDAQ 100 are up. So that shows you, I always say one day doesn't make a trend. I'm sorry, this is in my nature. I just saw this little uptrend line on ADP after that big wedge break down there. So there's a sell signal to come on ADP after that trend line breaks. So what I'm showing you is that it might feel healthy, this rally, but it's not healthy. And also tells me that's most likely, this is not broad-based buying. Institutions, if they were buying, this is probably the retail crowd chasing the beloved Mag 8, the ones that wouldn't let them in before and they just wanted to buy, and everyone wants to own Tesla and Apple and all those. But the rest aren't doing well. The other way to do that, it's very simple. If you don't have that option that I have where you can load all the components, just put an E at the end of QQQ. QQQE is the equal weighted NASDAQ 100 index. It also did just put in a divergent low, so that's why I'm cautious at this point in time my bearishness has been tempered quite a bit. It's in my nature to respect divergent highs and lows, even if it is a divergent low in a bear market. I already told you my thoughts. It'll probably not play out for a move to new highs, but it could certainly be the catalyst to play out for another, maybe a back test of the trend line. So again, we're watching this. I would, to increase the odds, the bearish case, and to get aggressively short again, I would love to see this divergence taken out, meaning the PPO moves down and takes out the previous low, and so does the RSI. Then you have very little case that it can be made for a nice rally. So QQQ, let me just update this chart. QQQE, that was a divergent high right there. That was the high, big leg down, counter trend bounce right back to the 200s. But I wanted to show QQQE is virtually flat. So that is a way to, if you ever want to get a quick real-time check on the health of a rally in QQQ. Again, I caution one day doesn't make a trend, but you can sometimes look at that stuff and, hey, is today's rally broad-based? And again, it's not. I told you the S&P 500, which is more diversified, is flat, and so is QQQE. So if you are trading QQQ, know that it's just, yeah, it probably is going to get sold into. So I do believe this is an April Fool's rally. Most likely, that's my take. I was trying to come up with a, let me see if I have here a picture of it, a caricature of the, of what I think is happening, and I think this is just the retail crowd. I've got that AI stuff on my phone. You can just kind of say what you want. I told it that no, I didn't spend any time doing it. I just did the first prompt. Had a crowd of retail investors chasing stocks like Apple. I guess copyright stuff. If I would have thrown in all the symbols, there's Pinterest. It kind of gave you quasi. I guess they don't want to violate the copyright, so they don't have all that. So these would be the stocks, and I really wanted them here. Just hands out, the crowd's chasing, and they're about to fall off a cliff, like a bunch of lemmings. Lemmings go off the cliff. So this is what I think this is today: retail crowd chasing the beloved names that they're dip buying, and but there's some red flags under the hood, as I just showed you, including QQQE. And then when you look at QQQE, remember, I always, you've got to pick a team. One thing I hate when I hear somebody say, "Oh, just trade the charts, trade what's in front of you." I can make a bullish or bearish case at any point in time. I could tell you right now, I recognize these positive divergences. I wouldn't shock me to see them go up and back test that. And I don't want to ride out a back test of even if I'm right in my longer term call. If this rallies up here in back tests, I mean, of course, I'm on QQQE still. That's a dang, I'm going to measure it for you to when it comes in. You're not going to hit it today, so it would take a while. So I'm moving forward in time. The uptrend line goes higher and higher every day. That'd be about a 9-10% rally. I don't want to ride out a 9-10% counter trend bounce. We'll watch this. But you can see from bigger picture, and again, this is what helps me, quote unquote, keep the faith, if you will. I was tracking and telling you way back here that you want to see the equal weighted breakdown as well. They are important. Again, it shows you the overall health of the NASDAQ 100 by putting an equal weight on every component instead of a market cap weighted formula like QQQ has, which tracks the NASDAQ 100. And so you can see that's a clean uptrend line from the October 22 lows. Lots of nice clean reactions, and then finally, most recently, a break and a back test and a rejection off the 200s. So as long as we remain below those 200s, I know I'm beating a dead horse here, saying the same thing over and over, and there's big resistance. That was where the support level on the NASDAQ 100 equal weighted was. We broke, we back tested it, got rejected, and so that's it. So I'm in the mindset overall, generally speaking, as a swing/longer term trend trader in a bear trend, I look to short rallies into resistance instead of waiting for a breakout above resistance to go long like I do in a bull trend. And then, so take it one step further. SPY just turned red. Earlier it was green. I was going to start the video and I didn't get it out in time. I wanted to show you that remember, the VIX is based on the S&P 500, not the NASDAQ 100. I just trade the VIX itself via futures because it's more liquid. NASDAQ does have its own volatility index. That's VXN. But it's just the instruments that track it and the futures. They're just not as liquid. So I just like trading and there's more juice in the VIX than you need. And it charts better and all that, but there's a NASDAQ Volatility Index, VXN. But back to that. Okay, so VIXY is our proxy. It it tracks the short-term futures of the VIX, and you can see it was even up earlier, even when the S&P 500 was up. So that's a good sign. Remember, this was that scale back in zone. We were long here, and then long on the breakout again, hit our first target, pullback was likely, and we got that. And then right before we got to this zone, I gave you that zone to scale back in, and went up, and we pulled back yesterday, as I highlighted, to that level. And so far, nothing big, but that support level's holding. S2, meaning support, it's a support level, it's holding. And then on the 60-minute chart, I'll give you it here, 50-54, so far we're holding. And if the S&P 500 and NASDAQ 100 break out above those 60-minute downtrend lines I gave you, you'll probably see the VIX break down. But as I told you yesterday, to me, the VIX is still cheap. That's a relative term. Please, please, please do not get me wrong. If the stock market rallies 3, 5, 10% from here, the VIX will go down. It'll go down more than 3, 5, or 10%. But proportionately right now, what I told you back here when I said it was cheap, the risk reward was phenomenal in my opinion, because the upside potential based on my outlook for the markets and the VIX itself, because the VIX was trading, remember, down near the low end of its historical range. So even if the stock market had gone to new highs, the VIX proportionally would fall a lot less than it normally might. You don't want to be heavy aggressive into the VIX when it's at near the high end of the range. That's just again. But as I said, remember, we were here on the VIX, here in previous corrections. This stock market just made recently an all-time high, and then started to reverse. We've had the biggest drop we've had in what? I think they said that March ended as the worst month since 2022, if I'm not mistaken. That's the headlines. And biggest drop. Nearly straight down. The VIX, in my opinion, is still not reflecting that. And again, that keeps me bearish, because if the VIX had a big spike, had we hit T2, my second target already, I might say, guess what? A lot of people got bearish pretty quick. That means they bought a lot of puts. That means they sold, had some washout of longs. We're not seeing that. It tells me there's a lot of non-belief. In other words, it tells me the vast majority, if you take all market participants, professional and individual, collectively, they think the worst is over, because they're not buying a lot of put protection right now. They're still buying calls, looking for new highs. They're buying Apple, Amazon, and that's what I love to see in a bear market, to kind of keep me short from a longer-term perspective. I want to be a lone wolf. I don't want to see everyone else bearish. I don't want to turn the TV on and having all those bobbleheads that are consistently wrong agreeing with me. I want to be kind of in, when I'm shorting especially. When you're bullish in a bull trend, if you're in some runaway market, like crypto or .com bubble back in the 90s, yeah, that can go on for a while and everybody can be bullish. But when you're a short seller, you've got to be nimble, man. You just got to be, you can't stay too late to the party. The profits are tremendous, but you're going to get short covering rallies and counter trend bounces that are pretty powerful. So you got to kind of thread the needle more precisely, because bear markets and corrections, they happen much faster. They drop in a matter of weeks to months. You will make in a bear market, if you're an adept short seller, more than you'd make in months or years. And again, if you don't believe me, just look at any chart, go back in time, pull a long-term chart, and just measure the drops and when the corrections and the bear markets came, and you will see that like in 2007, last real bear market, in just a matter of just over a year, you wiped out all the gains that the stock market made in the preceding. If you just take a line from that point over, so I'm just going to go here to the left, that tells me you went back and wiped out. Oh no, I got to go currently. I got it here. Got to do it this way. Turn that off. There it is. So by that drop into the '08 lows in November of '08, you wiped out every penny, all the gains that it took the market from the beginning of 2003. To make. So 6 years of gains were wiped out in just over a year. And again, that's not an outlier. That's COVID did it. Q4 2018 drop, which we milked with impunity from the highs to the lows, reversed. That one was wiped out 1.5. That was just I call it the Q4 drop because it started right at the beginning of the fourth quarter and ended right around the end of the year. And so that's 1.3 years of gains, hard-earned gains, were wiped out in 3 months. And again, that's the norm. That's what tends to happen. And so hence, once again, my fondness for shorting corrections and bear markets, whether it's the stock market or coffee or wheat, corn, soybeans, gold. Oh, let's talk gold. All right, I'm probably rambling on the stock market. You know my thoughts. I think I made it clear. Let's talk gold. Now, gold, I will say, has just been resilient. Everybody, it's kind of like the .com or any big thing. When crypto for a while was unbreakable, Bitcoin just go up, up, up. If you traded the .com bubble, overbought, came more and more overbought. It's not just individuals. Central banks have been buying gold, and I get the whole thing. Nobody knows where to put their money because Bitcoin didn't prove to be what the Bitcoin heads or whatever you call the crypto heads thought it would be, a great alternative to the rigged financial system. And, we've seen, as I've pointed out repeatedly, it's been almost perfectly correlated with the stock market. Stock market rallies like today, Bitcoin's up. Stock market drops, Bitcoin drops. And so it's not proved to be that safe haven that if the world comes in, stock market crashes, the government prints too much money, you're okay in Bitcoin. So far, it's evolved into a complete, at least until that changes. And it has been an on-off relationship, but it's a risk-on asset, meaning it's going to move up and down with the stock market. So that goes back. Gold has regained its title for thousands of years. It has been considered a store of safety, and that's what's going on now. And it's also, back in the 70s when we had those last time, almost half a century ago, we had a similar inflationary environment. Gold did very well in that. So people are just doing. So again, be careful. I wouldn't, don't go heavy short. I'm looking for the next correction. That's all I've been doing with gold so far, is trading these corrections, pointing out, objective buy points when we come back down, hit my targets. That's a level I need to add right there. I just noticed that if it gets ugly in gold. But gold is a very crowded trade. Just as crowded as Bitcoin was, 6 months ago or whatever when it peaked. Okay, so I gave you this today. There's not a lot to add. We broke down. There's a nice, clean, well-defined. This is that 60-minute chart I gave you on the futures. 60-minute well-defined bullish falling wedge, breakdown, first support, second / targets if you want. And then ultimately, I think we'll come down here. And then silver, of course, I usually will trade silver and or GDX because they follow gold, but they just go up or down more in a multiple thereof, So GDX, I threw it out as an official trade idea for you a couple weeks ago. And in that last post, which I made clear, gold had to break, which it didn't do. It triggered the first sell signal right here. It broke this wedge. Oops. That was when I first threw the GDX idea. That was sell signal 1, but I said it would have to break. What was it? This we got right there, 276.93. And because that was good support, or what I call the BOD, benefit of the doubt support. It hit it, and it held support. That's why I always say support is support until and unless broken. Now we're so far above it, and we had that. This is comparable to that smaller wedge I just showed you on the futures. That broke down. So now at this point, that actually becomes a target and might be the only drop we get in gold if indeed it happens now, which that'd be about 3.5%. But so therefore GDX, it broke now. This is I give it to you, was right here above this trend line. So there's the breakdown there. That aligns with the breakdown in gold futures, which I put a higher weighting on than GLD. And there's that. Let me get to some questions. Let me do that. Every now and then I like to take the time in these videos to just go over some of my replies to some of the questions that are on the site. Great questions. No such thing as a stupid question. Please throw them out there. I love this stuff. And sometimes, and even the trade ideas or opinion on something else. A lot of the trade ideas I find on the site come from you guys. Hey, Randy, what do you think of XYZ? Oh, wow. That looks great. And it's in this, ABC sector that I usually follow, but I hadn't looked at. And I just went in there and found 5 other great trade ideas. So, keep those coming. Updates on any existing things that I've covered in the past, but I might not have covered lately. Let me just go over this. So here's a great question. Does it make sense to chart dust and add my target and stop loss alert levels to that chart? Or should the alerts and technicals be added solely to the miners and gold spot market charts? Great answer. Great question. I'm sorry. Great question. Hopefully you like my answer. I don't mark up the leverage ETFs, whether they're 2 or 3 times, because of the decay, which is more pronounced with higher volatility sectors and commodities such as the gold miners, natural gas, etc. That's key right there. I'm going to just pause and sidebar for a second. For example, you have, if you want to short the S&P 500 and you don't have a margin account, let me get a freehand tool here. Let me just use this. If you want to short the S&P 500, you can either short SPY or you can buy any one of the SH is the non-leveraged. They all have it. NQ, the NASDAQ 100, you have PSQ, I think it is. You can look that up. Don't quote me to it. That's the inverse, but no leverage, negative one-time NASDAQ QQQ. SH is SPY in reverse without leverage, just one-time short. I go 1X. Yes. And then you have the 2-time leverage SDS for the S&P 500. I know is one of them. And then you have SQQQ. XPX. It's been so long. I usually trade futures. XL is the 3-time long, and then SS. That's it. SPSX is the 3-time bearish. So what happens? S&P is not that volatile. So if you go with a 2-time, you're not going to have a lot of decay. Now let me get back to that. So if you're not familiar with the term decay, do this. I'm going to show you right now how to find it. Click on resources, frequently asked questions, ETF related questions, and then this one here about holding ETF for an extended period of time. Made this years ago. Very good read, and I'm going to show you a real world example of it. So I'm not going to sit here and read it all for you right now. Read it. The math is there. It's very simple. It's not complex. And I did this because there are a lot of bobbleheads out there over the years. I've seen articles from Market View or whatever those, a lot of people say, oh, they're the scourge of Wall Street. Wall Street should ban them. Yes, they're created for day trading. They're meant to be in and out day trading, not buy and hold vehicles. And you will, over time, lose money in almost all of them by holding them long. And again, most important takeaways, very, very important. The more volatile the sector, you're not going to get crushed on SDS, the 2-time short NASDAQ or S&P 500. But you will get crushed on dust or nugget, because the gold mining stocks are way more volatile than the S&P 500, up, down, and that's where the decay really kicks in. And I went on so far to say that there are times where I will actually favor, even for a swing trade, an overnight hold, a multi-week, even a multi-month hold, I will favor those leverage ETFs, because you can actually, and I don't see this written ever, you can actually outperform the non-leveraged one time. In other words, the decay works in reverse for you. And the math is here, so you understand that. And I'm just going to show you in the real world. So as I said in there, and it's very important, if you read that through that question, my explanation is you have to have a unidirectional trend. What is a unidirectional trend? That is when, and what isn't? Let's just look at GDX right here. So here's a uptrend, right? But it's not unidirectional, it's choppy. You were definitely in an uptrend. We were right there, long at the lows on GDX. That was, back then it was great support, a lot of reasons to go long, some initial targets. But then the initial thrust was unidirectional. Then you started having some pretty decent corrections. This is where the decay will eat at you. The only thing worse than that is sideways, this kind of crap right here. You do not want to hold a leverage ETF, long or short, in a sideways choppy market. And especially on a volatile instrument. But let me just show you the math, how it works here. So let's just pick a point right here. Let's just go. This was GDX bottomed in March. We were, I think, that day or right there, long and it was just a beautiful. The charts were so set up at the time for to get back into the minors. We went long there on that divergent low and that one there. These were the initial targets, but I wanted to see, you can see my initial targets were where I figured we get the bulk of it, and that's where I favored and even traded myself Nugget, which is a 2-time leverage long. And minors are so easy; they all move together. You can just go with an ETF, or you can trade the individual ones. I'll cover those when I'm really bullish or bearish. So I'll go through the charts of all the minors. But I just want to show you from that low to the high. That's virtually here. Let me zoom in a little tighter. Grab the bottom of that candle. My pop-up box on the left shows it was all green sticks up to that point when we hit my fourth target. 18.9%, right? You can see the pop-up box at the left or on the bottom. So hopefully there are no splits or anything that dividends paid. Sometimes that'll skew the numbers. But we're going to go to Nugget, and I didn't do this before. I'll pick another period or a couple others if it doesn't work. But it should show me now. Logic says that you should be up 36%, right? Going from the same candle to the same candle, you're up 38.6. A little bit better. Again, now let's try it from here to here. There was a correction, but we had, a decent run to that point before a pretty big drop. 88% gain in Nugget, and GDX did, I'm going to guess, less than 44. I'm just guessing that. 40. See? So you can see if you can catch these unidirectional trends. And I work very hard to do that. Not only do I, provide price or where I think things are going. Of course, the only guarantee I'll ever give you is I'm going to be wrong, and I'll be wrong a lot. So take that one. That's what stops are for. But I tend to look at chart patterns and can tell you which ones have the potential to be explosive and have this kind of unidirectional trend. And I can also identify pretty often when things are likely to consolidate for a while. And so therefore, I might be longer term bullish on the miners, for example, but not so certain on when they're going to take off. Or like wheat. Well, wheat doesn't have a leverage ETF, but I've been bullish for a while. We keep hitting the lows. I'm sticking with that one longer term. But if there was a 2 or 3 time leverage wheat ETN long, I would absolutely not be in that right now. But you want the non-leverage. So these are the periods there. There's another fairly unidirectional rip. GDX went up 27.4%. Or if you bought Nugget and UGT, that's coming off the January lows, you went up over the same period of time, you did almost 60%. So the case has been, and now here's the takeaway, guys. This will bring it home for you. Okay, so let's talk about here's GDX. So let's say you've been a bull on the mining stock since let's say COVID, right? All right, and you're a gold bug, they call it, and you think gold mining's and gold's always going to go up and all that, and you bought. Let's just say for shits and giggles, that's where you bought back at the peak there. And GDX had a nice correction, but guess what? You're happy. You finally not only broke even after all these years, that was in early 2020, but now you're actually positive. You stuck with your trades. Congratulations. You stuck to your guns. You might even have collected some dividends off of some of these mining stocks, or GDX, it passes them through. So great. You're back to where you were, right? Now let's say instead you decided to go with Nugget back then. You bought the highs. Today, you would be down 70%. That's the decay. Let's say that, all right, that's a little far back, a little extreme. Well, here's a peak right there, right before that drop. You're right now from that peak in early 2022, you're up about 10% in GDX. So you should be up, quote unquote. Obviously, you're not going to be 20 in Nugget, right? Wrong, because of the decay. You bought that high right there. You're actually, instead of being up 20, you're down 22. Okay, so I impressed my point. And I know this might be basic to some of you, especially following me for a while, but so you got to understand how these leverage ETFs work. There are times that I will throw it out there when I throw a GDX as a trade idea and say, no, right now my confidence isn't that high. So, but you can use Dust. It's only 2 time. Believe it or not, Nugget and Dust used to be 3 time. They were probably on the verge of blowing up. I told you got to be careful with leveraged ETFs. You have to be careful with ETNs. I've told you how those work. They even have more risk. But leverage, they use derivatives to juice the returns, and in a certain market condition. I remember I used to have been trading Nugget and Dust since they came out, and they used to be 3x, and then one day they just suddenly announced they're going to change the leverage factor on them, and I have to imagine there were some issues there for whatever reason. Maybe they weren't tracking well or whatever. And again, the gold mining stocks are inherently volatile to begin with. So that's where you really got to be precise. Don't sit and hold these things if the trend's going against you for 6 months, a year, 2 years, or in a choppy market. Okay, end of that. Let's see what else I have for you. I don't know. Oh yeah. Let me go back to the questions. A couple more things if you're still with me. It's a slow day, so I'll cover this. Somebody else put a great question. I'm glad they asked the question. It's right here, I believe. Let me go. This is the previous post. 8 comments. There's a good one you might want to read. Randy, interested how you enter trades. Are you looking, if you're looking at a 1-hour chart coming into support and resistance, do you wait for a 1-hour candle to print in the zone to confirm your entry, or will you enter on a smaller time frame, like a 5-minute candle print? Thanks. Great answer. Great question. Again, sorry, great question. It depends on various factors, including how confident I am that the breakout or a bullish or bearish chart pattern or a reversal off a move into support or resistance will occur. The higher my confidence, the more likely I am to take a breakout right away before the candle is finalized on the time frame I'm trading. In other words, if I see a 60-minute bullish falling wedge pattern and I have a very high degree of confidence it's going to break out, especially, for example, if that security has come down to hit both good price support at the point of the wedge. Bullish wedges, whether they're bullish or bearish, that's a bullish falling wedge, bearish rising wedge, they typically break out around 70 to 80% of the apex of the wedge. Apex, if you draw a wedge, and that's where the 2 points come together. They usually don't break out here. They usually break out around that sweet spot. It's not a hard set rule, but that's roughly where they do. So I can eyeball wedge, look at if it's going to break out, where it's likely to break out. And then all the better in that case, it hits support. So I'm going to take a position, maybe a full position there in that case, maybe a half position or a third, and then I'll add if the breakout occurs. So I went on to expand a little bit more on that. But again, a great question. It has to do with a lot of things, but including, and not limited to, but especially my confidence, where I'll take that, or will I sit back and wait for the candle to be finalized. Usually before going too aggressive, I'll wait for, whether I'm trading on the 60-minute chart, daily, weekly, I'll wait for the candlestick to finalize, meaning print at the end of that period. Like I showed you, a 60-minute candle on the 60-minute chart is going to print. The first candle is a 30-minute candle, prints at 10 a.m., then every candle every hour thereafter into the 4 p.m. close. Can you? Oh, here's one day I want to cover this in case anyone's chasing yield. Could you take a look at BKLN for me and get your opinion? It's Invesco ETF paying 8% dividend on senior secured corporate debt. Who doesn't like that? Okay, so my quick story. Here's my reply. I'll read it to you quickly, and then I'll give you a story. I'll expand on that. I just looked at it. I don't like it one bit. In fact, I've been tracking one of the basically identical clones of BKLN in one of my videos. One of the ones either yesterday or the day before I told you I've been watching a lot of things. I'm going to cover that. I'm watching the bank broker dealers. I'm watching the regional banks, the large banks. I'm watching treasury bonds, corporate bonds, investment grade corporate, below investment grade corporate, aka junk bonds, and the senior floating funds, aka senior loans or floating rate funds. So one that I watch is, I'll show you. There's a bunch out there. But what they are, okay, so for those of you new to the site, my former background, out of college, I became a stockbroker. I started with Merrill Lynch, then went on to bank brokerage programs with the whole Glass-Steagall repeal, where banks could now start playing around in the stock market again. They just had to open up a wholly owned subsidiary, a brokerage firm. So, it was Barnett Bank, Florida's largest bank at the time. Then they got bought by Nations Bank, which then got bought by Bank of America. So went from one to another, and then worked for Huntington Bank out of Columbus, Ohio, but in the Florida branches running those. And then Fifth Third Bank, and then AmSouth, and was the last one they got bought out. These regionals kept being bought out. There's a lot of changes in the region, but it was a great place to work as a financial advisor. I mean, if you're a stockbroker, you network, trying to build up a client base. When you're doing it for the banks, they own the bank. They send you somebody deposits $500,000, $1 million in their checking account. they're gonna, hey, you go see Randy. It was a great job. I loved it. But anyways, I left that for my true passion, trading stocks. But I want to give you a story here. So back in the day, and we're going back into the 90s, the first bank brokerage I worked for, we were just selling the crap out of something called it was the Van Kampen Prime Rate Fund. So it was a mutual fund. I predate, before ETFs. I got in the business, there weren't ETFs. They were just being evolved. The UITs were the early variation of them. Started selling unit investment trusts, closed-end funds, and the ETFs started proliferating in the late 90s and into the 2000s, and now they're big. But back then, so there was a mutual fund. And, I was, in my 20s, young stockbroker, financial advisor, and drinking the Kool-Aid that they would serve you. And that was, these things are super safe. This Van Kampen Prime Rate Fund was a CD alternative. And I was working the bank program. It was so easy. I have money, I got a couple 100,000 CDs. Here's a thing. It's going to pay you, 3% more. Stable. It always keeps a $1 share price, or 10. That fund kept a $10 share price, like a money market keeps a $1 share price, a brokerage money market fund. Well, anyways, and they'd come in and tell us why it's so safe, and the pitch was, and these things are here today. That's what BLKN is. These senior rate funds, floating rate funds, or senior loan funds are just that, but they're not bonds. They're loans. So you have in the corporate world, you have a hierarchy of debt, and let me change the color here to blue. So you have this hierarchy of debt. You have I'll keep it simple. You have stockholders, common stock, then preferred stock is above that. Then you have bondholders, and of course there's different tiers or subordinate bonds get paid below the higher bonds, and then you have senior loans. So let's just keep it simple. So this is, I don't have a writing tool. B for bonds, PS or preferred stocks, common stocks. And then these are senior loans. So not all companies issue the senior loans. So bonds are fixed rate. You guys, most of you know that. A bond is an IOU. So you buy a bond from a company or the federal government. You know the term. It's a 5-10 year. You pick the term. And you know your rate. No surprises as long as a company. But like any bond, an IOU, it's only as good as the issuer. So that's where you buy a treasury bond. You have no risk of default. Government will never default. They'll just print more money. If they can't pay their debt, they just print more dollars. Corporations can't do that. So with corporations, you want to stick with AAA, single A, but you get the lower rates. So most people go down the lower spectrum. But that's what a bond is, an IOU. Preferred stock says if a company goes bankrupt, something happens, here's how it works. Senior loans have to be paid off first. Then the bondholders, and again, you can be, some bonds are subordinate to others, but the stockholders cannot get a penny until the bondholders have been paid off. So once the bondholder, if a company, after everything's said and done, there's 50 cents left on the dollar, then the preferred stockholders get paid, and then at the very end, common stockholders. So common stock is what you're trading. Apple, Amazon, AMZN is Amazon common stock, PPL is Apple, that's common stock. So that's at the end of the line, but obviously higher potential, right? So you go down the lines. But these senior loans, it sounds great. Oh, Randy, why wouldn't I just do that? It's not a bond. It's a loan similar to a bond. It's an IOU, but they're variable rate. So you want to go with those in a rising rate environment, not a falling rate environment. Number one, right now the interest rate environment is very unstable. I could sit and talk on that, but I'm going to sidebar, and it's not worth it. Let's just talk about the safety. The companies. Again, from my experience, I haven't pulled the prospectus on BKLN. You can read up on it, but my experience, these guys are almost all the same. They are low grade. These are companies that if they sold a bond, or they do have bonds out there, they're junk bonds. They're typically either on the bottom tier of investment grade, low, triple B rating, or they're below investment grade. They're double B, single B rated companies. And that's fine. You can be, when I say junk bonds, junk bond funds are great in a strong or healthy stock market economy. They're going to pay you more than treasuries. And if the economy's humming along, things are good. The default rate on those bonds are very low. But as I've mentioned many times, the reason that I'm looking when I'm watching credit spreads very closely. It's not a matter of if, but when the next recession hits. Recessions are as certain as death and taxes. The Fed has happened to muck around tremendously with the business cycle by keeping rates artificially too low for too long, injecting too much money into the system. First with the financial crisis in '08, they kept the pedal on the metal. COVID hit, and they just hit the all-out nuclear button. So too much stimulus, too much money, and they've prolonged what is a natural cycle in the financial markets, and that's expansions, economic expansions, and then contractions and recessions. It's just been a whole long time. COVID was a recession, but if you blinked or you were sleeping too long, you missed it because the government, again, didn't let it happen and run its course. So where I'm going with this is this might look great, sounds great, senior loans, but it's like loaning money to a friend. When you look at these companies, say, oh, these are senior loans, or any of their first in line to get paid. Well, you can either lend money to your cousin Bob, who you know is a solid guy. He's got a steady job. The last thing in the world, he would sell the shirt off his back to pay you that loan back if you had to. Or you can loan money to your cousin Rico, who Rico's always losing jobs, doesn't, he's not an honest guy, he's not going to pay you back. That's what these loans are. These are they're not the you're taking a risk with these loans. And again, as long as the economy stays good, unemployment stays low, economic growth is good, these companies are humming along and they're able to make those payments on their debt. When things turn south, just like junk bonds, that's why junk bonds trade, unlike treasuries and high-grade corporates, junk bonds trade in line with the stock market. And I gave you a couple the other day. There's JNK is one of them. And here, let me look at that senior loan fund, BKLN. So obviously, the main thing was my outlook on the economy and the market. For that reason, I don't like these senior loan funds. You can see there was COVID hit right there. They plunged with the stock market, and that was a huge drop right there. And you can go back far enough if this one's been around. Nope, it wasn't around on the last one. I have a couple others I follow. Let me find one. Here, this is on a watch list I watch every day. I call it my TTW, things to watch list. And so it's a floating rate fund. So we know, let's say, for example, let's go, we've seen lately treasury yields. I'm on a weekly chart because I just want to show you time frame. These are these are the IEF, the 10-year treasury bond. We're just looking at the 7 to 10 year. And you can see that the prices have been moving up. Yields have been falling since they peaked here. Yields go down, bond prices go up. So we've seen an uptick. And then JFR is floating rate. But you can see it's kind of stalling out. And so far it's been going down, down, down. The bigger trend is down. But during the bear markets and recessions, these things will plunge. Why? Because just like junk bonds, which JNK, credit quality matters, not the yield they're paying. They're much less sensitive to changes in interest rates like regular bonds, because all of a sudden, again, in a healthy economy, default rates are very low. All of a sudden the economy turns, and the faster it turns, the more defaults can really surge. So there's my kind of be careful with that thing. So my analysis was more so on based on my fundamental outlook. But when I look at the chart, I don't see anything I like either. I'm just watching it. And that's JFR right here. Did I turn off? Yeah, I turned off all my levels. You can see I've been charting JFR and watching it. That was a breakout right there. That was the time, if you asked me back then, and I'm sure that BL BlackRock one, same thing. They're just holding, and you got to dig down. And again, if you're going to put money in one of these, take the 10 minutes to go to the website of the issuer and read up on the prospectus. Look at the whole, they'll list their top 10 holdings, and you'll see companies like whatever they are, and then pull those companies up. Look at their stock. How do they look? If the stock price is pretty bad, which usually it is. I know a lot of these in the last year or so I looked, it was Ford and they had Global Star, some satellite companies again that have, aren't, balance sheets aren't hunky-dory, or they wouldn't be issuing these loans. And on JFR, you can see right there, if it breaks at 835, it's probably going lower. So this is a time I like to, get bullish and look to buy things, big divergent lows after a big drop, especially on a buy signal breakout. And this is when the trend is usually over, after the rally's run its course. And you've got, instead of positive, you have negative divergence, which I guess this is the last time I updated there. and then I put in that divergent high. It went on to break down right there, back test. It's dancing on support. If we are going into recession this year, this is probably going to do this. If I'm wrong and Trump pulls a rabbit out of his hat and all these tariffs work and America's going to be great again and they're going to just prolong the next recession for a while, yeah, sure, this has some potential. But you'd also want to see it, you'd also need to see rising rates, and it's a catch-22 right now. These floating rate funds, again, the loans are pegged at a variable interest rate, and so you want to own them in a rising rate environment, not a falling rate, or your income is going to keep dropping. But what happens, guys, right now? What's everything the stock market's been, as I've mentioned for over 2 years now, super sensitive to interest rates. And I gave you those zones on IEF, the 10-year Treasury bond, and it was super simple to me. It's a vicious cycle we've been in. Green zone, everything's good. Low rates, Treasury bonds come up here in price. That means the rates are falling. Stock market likes it. But you get in the yellow zone, especially the orange zone, where the stock market really starts to take note. Right now, we're rallying for the reasons I said before. The only exception to this is if a strong stock market sell-off causes bond prices to go up. That's a flight to safety bid. That is not an organic rise in bond prices, drop in rates. It's the opposite. It's institutions selling stocks because they don't like the outlook for the economy in those companies, and they're moving money into, which they always have, into safe haven treasuries. And so that's why we're in the green zone right now. So that is not as green as it would be, because we know that the stock market's down and its biggest drop since 2022, biggest monthly drop. All right, I probably bored everybody to tears now. Let me see if there's anything else I missed. Somebody asked about lumber. I put my lumber chart. My opinion, not very strong right now. Potential UPS bounce trade on the chart. Sure, I think if the markets bounce, I meant to reply to that one. I'm just going to do it now. UPS looks as good as anything. In fact, I threw it out as a trade idea twice in the last year. Once we went long, I think it was somewhere at that support level. We hit my first and then second target with a perfect, we gapped above it. And so when you gap above a price target, that makes wherever you open to the new price target. Again, because you couldn't sell, you gap above a price target, that's where all your sell limit order will get filled at that better price. So we exited that one perfectly. This time around, we went long again on the divergent low, hit my first target, but now the market's been falling apart. So T2 is probably not likely going to be hit unless this market somehow turns around. And that's possible. Trump's going to, I don't think he's made the announcement yet on Tariff Tuesday or whatever the hell they're calling it. Liberation Day or whatever stupid thing. There's a divergent low right there as well. But remember, we had a divergent low here, right? We had a divergent low there. This is a bear market. It's mean. It's cruel to bulls. It keeps setting up these. And I'll game them. I love bear market rallies. We've gamed twice, two of them so far. But that was a big level, and I believe I commented on it then. Let's see what I said. I can't even remember now. Just go here and go back to the site, and the top of the site, and go to. You can find any tick you're looking for this way and go to, no wonder I can't figure out my own site here. Resources. Or no, we can go to trade ideas. Trade ideas. I haven't updated these guys. I'm sloppy and just the trade ideas. From time to time I'll go and update them. Let's see, I probably still have that listed as an active trade. UPS. Last update was February 12th. Again, I throw out so many trade ideas and I can't even remember what's what. Trade idea update, daily chart. Yeah, okay. Oh, that was the previous trade. We went long right there off the lows, like I just showed you. Hit T2, we gapped above it, so we filled it better than the second final target. And then I was that it? Oh, yeah, this is where weekly chart. Once again, we offered a low there. T1 hit weekly. Anyways, my comments are, I'm not even going to read the whole thing here. Oh, I guess we started to say that, here it is. Yeah, I started when we hit T1, I'm going to give you my thoughts, that entering a long position in NASDAQ 100 now that the downtrend line and deep seek gap resistance I've been highlighting recently tempers my outlook for UPS now. Although, Oh, I guess that was when I first threw it out there. I'm sorry. So I never updated that. Look at that. Okay, I'm wrong. We hit T1. Let me make sure. UPS. So that last time I covered it. Click on the tag. 317. Oh, I would have covered it in this video, March 17th. Okay. All right, guys. I'm sorry. Like I said, I cover so many stocks and everything. I can't even keep track of them all. I take a lot of the trades I throw out. I can't take them all. Sometimes they're duplicates. I'll cover, go over the mining stocks. I'll cover all 20 something components of GDX, and sometimes I'll take some of them individually, or sometimes I'll just take GDX, or sometimes I'll even pass on a trade idea I share. Hey, if you like it, take it. I'm not taking it this time. All right, let me wrap it up here. It's been another long video. Kind of just rambling on a slow day. And if I missed anything, any questions or chart requests, bump me under the most recent post. I'll usually check that, and I'll try to get back to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a great day.